Hello friends, welcome to the section number 3 of the economic survey and the budget analysis. So दोस्तों हम लोगों ने अभी तक 2 लेसन्स कवर किए हैं. फर्स्ट लेसन में हमने देखा हाउ टू स्टडी द इकोनॉमिक सर्वे एंड द बजट. सेकंड लेसन में हम लोगों ने देखा कि जो इंडियन इकोनॉमी है उसकी परफॉर्मेंस कैसी रही है. फ्रेंड्स, I am also getting the request that I should have 100% of the session in the English, and there are counter requests also that I should have the mixture of Hindi and English. So what I am going to do is that I will be having the mixture of Hindi and English, and I will ensure that all the things that I discuss in Hindi, I also say the same things in the English. So they will be dual advantage. So those people who know both Hindi and English, they can listen to the same thing twice. So their learning will be double. And for those people who are having problem with the Hindi, they will get everything at least one times. So this is how I will be proceeding in the subsequent lectures. If you have any other alternative, you can give me a suggestion in the comment also. So to start with, in the lesson number 3, so this is the lesson number 3. Here we will be focusing upon the fiscal sector. So the fiscal sector is basically also called as public finance. Public finance, or here the word public means government. So the finances of the government, right? There is a popular term called budget, which reflects the finances of the government. So we will be discussing about the basic concepts also, and we will also see the previous year questions of the UPSC, so that you can see that what kind of questions can be asked in the examination. Overall, in the volume 2 of the economic survey, there are 10 chapters. We have already seen the first chapter. Now we are discussing the second chapter, and all of these chapters we will be discussing in the subsequent sessions. So in this session, we are going to discuss the fiscal development. We will be covering both the economic survey, observations, and the budget announcements. So as I promised you that I will be covering both documents simultaneously, in this chapter also I will deliver that promise. So to start with, first we need to understand what is the meaning of government budget. So budget, if we see in the Constitution of India, there is Article 112. This Article 112, it talks about annual financial statement. So it is the obligation of the President of India to lay down the annual financial statement in both the houses of Parliament on an annual basis, right? This annual financial statement is basically the estimate of the receipts and the expenditure in next 12 months, right? So what is the estimation of receipt, what is the estimation of expenditure in the next 12 months, that is being given in the annual financial statement. If we talk about the present budget covers the period from 1st of April 2020 till 31st of March 2021. So these are the next 12 months which we are talking about. Now, if we talk about the components of the government budget, so these two are the components. Component means the receipt and the expenditure. So receipt can further be classified into the capital receipts and revenue receipt. Similarly, expenditure also capital and revenue. Now question arises, what is the meaning of capital and what is the meaning of revenue? If we talk about receipt, the capital receipt is something which is either increasing the liability. So for example, the government takes the loan from the market, that increases the liability or the obligation of the government has to pay in future. So this is one thing. Second thing, the capital receipt is something which reduces the assets. Can you think of example? The best example is disinvestment. If the government sells its shares in the public sector undertaking, that sale is nothing but reduction in the government assets. So this reduction in the asset is also capital receipt, right? If we talk about revenue receipt is those receipts which are either in the form of taxes or there are some non-tax item which are received regularly. So they are recurring in nature. The main feature of the revenue receipt is that they are recurring in nature, they are coming year after year and they are not impacting the asset and liability. So there is no impact upon the asset and liability, right? There is no impact upon the asset and liability. It is recurring in nature. And revenue receipt can be either tax revenue receipt or non-tax revenue receipt. Expenditure can be capital expenditure. So capital expenditure is converse of the capital receipt. So capital expenditure will either increase the asset. Can you think of the example? The example is that we are spending some amount to build road, power plant, bridge. So all these assets are built and the expenditure on such assets is called capital expenditure. So there is increase in the asset or there can be decrease in the liability. Can you think of the example? The example is government repays its already taken loan. So the government took loan maybe couple of years ago and now government is returning back this loan. So this will be reduction in the liability or reduction in the obligation. Next is revenue expenditure. Revenue expenditure is expenditure on day-to-day activities of the government. So can you think of some example? Example can include salaries of the government employees, interest payments, expenditure on the defense, subsidies which are given by the government, and so on. So all those expenditures are the revenue expenditure. They are also recurring in nature. So if we try to classify between capital and revenue item, capital items are impacting the asset and liability part. Revenue items are recurring in nature. Capital items are not recurring in nature. Revenue items are not impacting the asset and liability portion, right? So this is how we classify the receipt and expenditure both into capital and revenue. We will see these things in further detail. Friends, it will take some time, like in this section I will take some time to build this basic concept so that our further discussion can be fruitful. If you are well versed with this concept, you can fast forward my lecture or maybe you can directly start with maybe after 5-10 minutes. You can skip the lecture by 5-10 minutes. The point I want to make is that I am trying to build these basic concepts so that you feel comfortable when I start discussing the budget part. So if we talk about the receipt can either be revenue receipt or it can either be capital receipt. Revenue receipt can be tax revenue receipt or non-tax revenue receipt. Tax revenue can be direct tax or indirect tax. What is the meaning of direct tax? So liability to pay, and so in case of direct tax, what happens? The liability as well as burden is borne by the same person. So for example, I am liable to pay my income tax, and the burden of that income tax will be from my own pocket. So this is the nature of direct tax, and the best example is income tax. So income tax is tax on the personal income. Corporate tax, that is income tax on the income of the companies, wealth tax, etc. Another is indirect tax. So in case of indirect tax, the liability and the burden are on two different people. The best example these days is goods and services tax. So I am the coaching institute, you pay me GST, and I pay to the government. Government imposes the liability on me, but burden is shifted to your pocket. So in case of goods and services tax, it is your pocket which is bearing the burden, and I am under the liability. So liability is with me, burden is upon you. So there are two different people. So this is how this indirect tax works. Best examples are sales tax, custom duty, excise duty, service tax, entertainment tax, and goods and services tax, which is the prime example nowadays. Many of these taxes have actually been merged into the goods and services tax. Non-tax revenue, it can include interest receipt. So the government has given the loan to the state government, to the other entities, and it is receiving the interest income on those loans. Profits and dividend. So government has invested into some commercial entity, for example ONGC, NTPC, and it is getting its own share of profit. So that is called profit and dividend. Fees and fines, external grants. External grants means the money being received from outside India. For example, Japan gives some grant to the India for developing some infrastructure. So that will be part of the external grant. Fees and fines, the government is collecting a lot of fees and fines from us. That is also part of the non-tax revenue receipt. Then capital receipt. Capital receipt can be majorly classified into two categories. One is the debt receipt and another is the non-debt receipt. Right? Debt receipt can be in the form of borrowing or in the form of public deposits like provident fund. So borrowing is something for which the government goes to the public and demands the money. Provident fund is something the public comes to the government, right? Non-debt receipt. So for example, loan recovery, disinvestment. So these are the examples of capital receipt. Friends, I know my speed is little bit faster because I am assuming that you have gone through all these basic concepts in detail earlier also. My focus is just to have a recap, just to refresh this concept in your mind. My focus is not to give you a detailed analysis of all these basic concepts, right? So for that I will need at least 3 to 4 time number of hours compared to what I am taking right now. Then we have expenditure part. In the expenditure we have revenue expenditure and we have capital expenditure. As I already told you, the capital expenditure, it either increases the asset or it reduces the liability. Construction of roads, bridges and building, it is creating of asset. Purchase of land and machinery, creation of asset. Investment in shares, creation of asset. Loan to states and foreign government, it is also creation of the asset. It is not that they are building something in the physical nature, but they have the right to collect it back. So it is also an asset. Repayment of loan, this is reduction in the liability. Right? So all these 4 items are the example of creation of asset or increase in the asset base, and this is the reduction in the liability part. Coming to the revenue expenditure, it does not have any impact upon the asset and liability, and it is recurring in nature. So example include interest payment, salaries and pensions, grants and subsidies, education and health services, defense services. Now, there is a concept called deficit. So what do you understand by the term deficit? What do you understand by the term deficit? So deficit is shortfall. Deficit means shortfall. Shortfall here indicates the shortfall of receipt compared to expenditure. So here the shortfall basically means that expenditure is more than the receipt. The expenditure is more than the receipt. So the deficit is equal to expenditure minus receipt. If the expenditure is rupees 12 and the receipt is rupees 10, that means we have the rupees 2 deficit, right? Now there are multiple kinds of deficit. For example, first major deficit is fiscal deficit. Fiscal deficit means, okay, so let me give you a little bit more detail, otherwise you might get confused. First is fiscal deficit. Fiscal deficit is equal to total expenditure minus receipts or total receipts excluding the borrowings, right? Or in other words, it is equal to the amount of borrowing. So whatever amount the government is taking as the loan, loan to meet its expenditure, that is called fiscal deficit. This fiscal deficit can be gross, it can be net. So gross means this amount only, and net basically means when out of the fiscal deficit we reduce the net domestic lending. When we reduce net domestic lending, that is called net fiscal deficit. Why we are reducing net domestic lending? So the concept is central government took the loan. It became part of the fiscal deficit. Out of the same amount which it has taken as the loan, some amount the central government has taken, central government has given to some other entity as a loan. For example, central government receives 2 rupees as the loan. Out of 2 rupees, it gives 0.5 rupee as the loan to some other agency, maybe the state government or any other government. So what is the net borrowing of the central government? How much amount central government is borrowing for its own purpose? The amount is 1.5 rupees. So this 1.5 rupees indicates net deficit, right? So this is net fiscal deficit. This is the first term. The second term is revenue deficit. Revenue deficit is basically very, very easy. The revenue expenditure minus revenue receipt. That means the amount which the government has to borrow for its day-to-day operations. This deficit is very dangerous because the government is borrowing for the consumption purpose. In case of capital expenditure, there is some asset being built, right? But in case of revenue expenditure, no asset is being built. It is a pure consumption. This is a cause of concern. Revenue deficit should be almost zero. Third is primary deficit. Primary deficit is basically the fiscal deficit minus the interest payment. So how this primary deficit is different from the fiscal deficit? In the fiscal deficit, we are including both the borrowing amount and the interest cost. In case of primary deficit, we are excluding the interest cost. Why we are excluding? Because this interest cost actually indicates the cost of borrowing which were taken in the earlier years. So this is the sin which was committed by the previous government, or it was committed by the same government but in the previous year. This primary deficit tries to calculate the performance of the government in the current year. So how much borrowing the government has to take for meeting the expenditure of the current year, not of the previous year. This interest indicates the expenditure of the previous year. So to calculate this specific amount of the current year, this interest is reduced. So primary deficit indicates the current year's deficit, right? Current year's deficit. Again, out of this primary deficit, this is the gross primary deficit. If we want to calculate the net primary deficit, we have to reduce the interest of the net domestic borrowing as well as the net domestic borrowing, right? So if we eliminate the net domestic borrowing, net domestic lending, then we receive net primary deficit. Friends, these are the major categories of the deficit. Now, my question is whether the deficit is a good thing or a bad thing. Friends, government is not a profit-making entity. Government is supposed to make the people win through welfare, through building school, colleges, bridge, power plant, etc. At the same time, the government cannot expend unlimited amount. So one thing is very clear, government is not a profit-making entity, therefore the expenditure should not be less than the receipt. At the same time, expenditure cannot be more than receipt to a large extent. So the economists say that expenditure can be more than receipt maximum up to 3% of the GDP. So 3% of the GDP is the acceptable limit. And out of this 3% GDP, the economists say that amount should go for the capital expenditure, for asset building, because this asset building will benefit the future generations, right? So having deficit is not a bad thing, but this deficit can be because of the capital expenditure. This should not happen because of the revenue expenditure. This is one thing. Now, what are the adverse impacts of the deficit? Deficit basically means borrowing, लोन ऑफ द गवर्नमेंट. सरकार ने जो लोन लिया है उसको हम डेफिसिट बोलते हैं. अगर लोन लिया है, इफ द गवर्नमेंट हैज टेकन द लोन, इट हैज टू रीपे द लोन. सो द फर्स्ट इंपैक्ट इज अपॉन द फ्यूचर जनरेशन. आवर चिल्ड्रन, दे हैव टू रीपे द लोन बाय पेइंग द एक्स्ट्रा टैक्सेस टू द गवर्नमेंट. सो गवर्नमेंट विल collect extra tax from our children, and then it will be able to repay the loan. So first impact is upon the future generation. Secondly, it has inflationary impact. Inflationary impact means when the government borrows for giving to the public, either in the form of subsidy or any other expenditure. So this amount goes into the market, money supply increases. Because of the money supply increase, purchasing power of the people increases, that increases the demand of the goods. But increase in the demand of the goods does not result into sudden increase in the supply. So demand increases but supply do not increase correspondingly. As a result, the prices of the goods start increasing. So the second impact of the fiscal deficit is that there is inflation in the market. The first impact is extra taxes by the future generations. Second impact is inflation. The third impact is that when the government takes the loan from the market, the private sector has less amount to borrow. So private sector may have to pay more rate of interest. So the investment or the capital formation by the private sector is hampered, right? So this results into crowding out effect. This results into crowding out of the private sector, right? So this is the third adverse impact of the deficit. So I hope that now you can understand why there should be control over the deficit, right? Now, to control the deficit, the government came up with one legislation which is called Fiscal Responsibility and Budget Management Act 2003. So in 2003, the government decided that we will make a law and the central government has to adhere to this law. As per this law, there are some target that fiscal deficit will be 3% and revenue deficit will be 0% of GDP by 2009. But unfortunately, because of the global financial crisis, these targets could not be achieved. So because of the global financial crisis, the government has to increase its expenditure through various welfare programs. Because of the extra expenditure, this deficit could not be controlled. Subsequently, multiple times there were extension in the time limit of 2009. Finally, in 2015, one committee, NK Singh committee, was constituted, and this committee gave its report in 2017, and this committee said that this FRBM timeline, it can be extended to 2020-2023. At the same time, there are some other recommendations, right? So it recommended that there should be target of fiscal deficit, there should be target of revenue deficit, as well as there should be control over the public debt. So let us see the recommendations in detail. So all these things I have covered in the discussion. So these are the NK Singh committee recommendations. First recommendation is that from 2016-17 to 2020-23, the fiscal deficit will come down from 3.5% to 2.5%. So as per the NK Singh committee, 2.5% is the acceptable limit, right? For the revenue deficit, from 2.3% to 0.8%. That means 0.8% is the acceptable limit for the revenue deficit. That means if we compare both, out of 2.5, 0.8 is for the revenue deficit. That means 1.7% should be the deficit because of the capital expenditure. So this much is acceptable, right? NK Singh committee introduced one very important concept, that it is the debt to GDP ratio which will be the prime anchor of the fiscal position. That means we will not judge the position of the central finances just by the quantum of fiscal deficit and revenue deficit. Rather, we will see how much is the total debt. At this point of time, I want to tell you what is the difference between the debt and the deficit. So there are two terms. One is deficit, another is debt. One is deficit, another is debt. What is the difference? Can you think of? I am giving you 10 seconds to think about it. Take 10 seconds and then we will discuss. So your time is started now. Okay, so 10 seconds are over. Now let us start with the discussion. Deficit means the borrowings of current year, right? So the amount that government has borrowed for the current year, that is deficit. That is the cumulative borrowings of the government. That means, for example, the government has taken the loan of rupees 2 for 2019-20. This is the deficit, right? If we see what is the debt, so for the past many years, government has been taking the loan for every year for that particular year's deficit. So in year 1, government took loan of 1 rupee, then 2 rupee, then 3 rupees, then 1 rupee, 4 rupees. In the current year, it took the loan of 2 rupees. So the totality of all the deficit, this is debt. Right? So can you understand? Deficit is the flow concept. Flow concept means it tells about the volume of anything during a period. So during 1st April to 31st of March, during the current year, it is talking about the current year. That is a stock concept. Stock concept means it talks about the amount at a particular date. At a particular date, that is as on the 31st of March 2020, right? So all the loans that have been taken till 31st March of 2020, that is part of the debt, and the loan which has been taken during 1st of April 2019 to 31st of March 2020, that is deficit. So this is the difference between the deficit and the debt. The NK Singh committee says that deficit is not the right parameter to judge the fiscal strength of the government. It is the debt, the cumulative borrowing, which should be taken care of. So coming back to the recommendations, here debt to GDP ratio was taken as the main parameter, and the NK Singh committee recommended that central government debt should be reduced from 49.4% of GDP in 2016-17 to 38.7% of GDP in 2022-23. So this is for the central government, and combined for the center and state, it should be 60%. Combined figure for the center and state, it should be 60%. Apart from that, it also recommended escape clause or relaxation. So in case of any undesirable situation, unavoidable circumstance, when the global circumstances are really bad, when there is a cyclical slowdown, and in many other situations, for example, there is a huge disaster. So in those situations, the government can deviate from the target by up to 0.5% in any given year. And what is the reason that I am discussing this concept right now? The reason is that government has adopted this relaxation for the fiscal deficit target for the year 2021. So the government has said that we will adopt this relaxation, right? So this is the reason why I discuss this concept, and you should understand what is the meaning of the escape clause. Now starts the economic survey. So till now we were discussing the foundation of the public finance sector. Now you can understand each and every part which I will be discussing now onwards. So this is the medium term fiscal policy statement. That means this is the target which was proposed or estimated when the new government came out with the budget in the July 2019. So when the government came out with the budget in July 2019, it indicated that for the next 4 years in the medium term, this will be the fiscal policy. So we can see starting from primary deficit. In 18-19, the primary deficit will be 0.2% and till 2020-21, it will be 0%. Next is revenue deficit. Revenue deficit will decrease from 2.2 to 1.7%, right? Third is fiscal deficit. It will reduce from 3.4% to 3%. And then central government debt. Central government debt will go down from 48.4% to 44.4%. This was the projected or proposed fiscal policy statement, right? But in reality, this could not be achieved. The government has given up on this target because of the bad economic situation which we are experiencing as of now. Now let us see the overall figures considering the previous figure. So in the previous figure you can see fiscal deficit, primary deficit and revenue deficit. This was the proposed statement for the next 4 years. But in reality, now the government is saying that fiscal deficit, it will move and it will increase in 1920. It will increase to 3.8% and in 2021 it can be reduced. Revenue deficit, it is increasing. You can see effective revenue deficit. What is effective revenue deficit? I did not discuss this point, so let me discuss right now. So the point is that in the revenue deficit there are some expenditure which the central government gives as loan, not as a loan, sorry. There is some expenditure, revenue expenditure from the angle of the central government, which it gives as the grant to the state government, and state government expands that amount for building the capital assets. So for example, central government gives 100 crore rupees to the state government, to the government of Haryana, and government of Haryana constructs one power plant because of that. So in the balance sheet of the central government, this is counted as the revenue expenditure, but in the balance sheet of the Haryana government, this is the capital expenditure. If we see overall macro picture, this is actually the capital expenditure only. But why we are showing the revenue expenditure? So to capture this notion, to eliminate this wrong notion, we reduce the amount of grant which has been given for capital asset to the state government. We reduce that amount from the revenue expenditure of the central government, and when that is there, we get the effective revenue deficit. So effective revenue deficit indicates the actual revenue expenditure out of which no capital asset has been constructed, right? So effective revenue deficit, it is also increasing year after year. Primary deficit, it is also increasing and decreasing subsequently. So overall you can see that government is completely shattered. Fiscal deficit as a percentage of GDP, this is the figure of the economic survey, and this was from the budget. So I am discussing both the statements simultaneously so that you get the comparative figure also. So economic survey is actually taking the budget estimate only. So for 1920 it took as 3.3%, but the budget took as 3.8%. So budget has actually revised the 3.3% target of the government to actual. So the point I want to make is that there are multiple type of figures which the government gives. So when the budget was presented in July 2019, the government said that for 2019-20, our budget estimate is that the fiscal deficit will be 3.3% of GDP. This was the budget estimate. Now, when the government has come up with the budget again in February 2020 and government knows that this target is not achievable, the government says for the 1920, the revised estimate, this is revised estimate, this is 3.8% of GDP, right? So economic survey is giving this figure and budget statement is giving this figure. Therefore, there is a little bit divergence you can see. So actually, this is going to be the real figure. Budget is going to be the real figure. So don't get confused. This is the purpose why I am discussing both the statements together so that you don't get confused. Revenue receipt registered a higher growth during the first 8 months of the 2019-20 compared to same period last year, led by considerable growth in the non-tax revenue. Can you think of what kind of non-tax revenue? Non-tax revenue includes interest and dividend. Interest and dividend. What is the meaning of interest? Interest basically means the interest income on the investment, and dividend means the amount of profit out of its owned public sector undertaking. So this dividend amount has been received from the RBI. Huge amount has been received from the RBI. Because of this, the non-tax revenue has increased. So can you see the interlinkage between the current year development and the economic survey? It is very clear. RBI gave the dividend, and because of that, the non-tax revenue increased. Gross GST monthly collections have crossed the mark of rupees 1 lakh crore for the total of 5 times during 1920. This is a very good aspect. These figures you don't need to remember, but you should understand how we are doing. Now there are some structural reforms which were undertaken as part of the taxation, and why we are discussing here, because this is going to impact the tax revenue, and tax revenue is part of the revenue receipt, and revenue receipt is part of the budget, and we are discussing the budget only, right? So that is why we are discussing the taxation. So there is a change in the corporate tax rate. The corporate tax rate have been decreased. Measures, so this corporate tax rate were decreased in the end of the 2019, right? Second, measures to ease the implementation of GST. So regularly the government is improving its system so that the GST implementation becomes very easy. Fiscal deficit targets of the states, they are within the target. This is a very good news. Survey notes that the general government, the center plus state. So whenever you read the term general government, this basically represents the combination of state government and the central government. So central government and state government combined, they are called general government. So survey notes that the general government, center plus state, has been on the path of fiscal consolidation. From your examination point of view, there can be a direct statement like this in the prelims examination, and you can mark that accordingly, right? So statement 1 can be this and statement 2 can be this, and accordingly one question can be framed for your prelims examination. Sorry. What are the reforms proposed for the GST? So this is the part I have taken from the budget. For the GST, a simplified return is proposed applicable from 1st of April 2020. This there will be SMS based filing for the nil return. So if there is no transaction, the businessman can just send an SMS and the return is automatically filed. Return pre-filing, improved in input tax credit flow. So overall there will be improvement in the transaction flow. Centralized system of e-invoices. So to avoid the tax evasion, to avoid the problem regarding the input tax credit, these e-invoices will be generated. Friends, I am assuming that you know basics about the GST. You know what is the input tax credit. So I am not going to discuss that thing in detail, because if I start discussing that, it will take another half an hour. So I am assuming if you are having any doubt, then you can send me an email or you can send me the Telegram query. I will resolve your doubt individually. System of cash reward to incentivize customer to seek the invoices, and Aadhaar based verification of taxpayers to weed out the dummy units. These things you don't need to remember, but I am covering for the sake of completion. Now these key numbers, you can see the first question arises whether you need to remember these key figures. Answer is no. You just need to have an idea that revenue receipt is approximately 15.52 lakh crore. Capital receipt is approximately 7.62 lakh crore, and total receipt is approximately 23.15 lakh crore. You just need to have an idea. No need to get into detail. Don't need to remember even the figures, right? So there is a ratio of approximately 2:1 in the receipt. Just a basic idea you can have like that, right? Total expenditure is 23.15, right? Revenue deficit, effective revenue deficit, primary deficit and fiscal deficit, all of them have been given. You do not need to remember the figures. You just need to remember how much percentage of GDP is the deficit. Now, what are the sources of deficit financing? Deficit financing means from where the shortfall in the receipt has been covered up. How the government has ensured that even if there is shortfall in the receipt compared to the expenditure, the finances are arranged. So what are the sources of financing the deficit? So there are multiple sources. Net market borrowings, right? The borrowing from the market. State provident funds, so the amount which the employees deposit in their provident fund account. External debt, the debt which is taken from outside India. Securities against small savings. So there are many small saving schemes. Other receipts. So we do not need to actually get into detail. You just can you just see this black arrow which is representing the net market borrowing. This net marketing borrowing has been increased from as compared to 18-19 in 2021. So earlier it was just 50,000. Sorry, not 50,000. 4.4 lakh crore. Now this is 5.6 lakh crore, right? So in the absolute term, this has been increasing. Rupee comes from. So what are the sources of receipt? What are the sources of receipt? Borrowings and other liabilities, 20%. 20% of not GDP, 20% of the total receipt. If total 100 rupees are received, then out of 100 rupees, 20 rupees are the borrowing and other liabilities. Here the borrowing represent the amount of money which the government requests from the public, and liabilities represents those amounts which the public itself keeps with the government, for example provident fund, and this becomes the liability of the central government. So this is the borrowing and the other liability. Non-debt capital receipt. Can you give the example? Example is recovery of loan, or another example is disinvestment. So this is very, very less. This is just 6%. This is very, very less. If we see, so these two combinedly, they are the capital receipt. Rest of all, they are the non-capital receipt, or they are the revenue receipt. Out of the revenue receipt, this is the non-tax receipt, 10%, right? This corporation tax, income tax, custom, union excise duty, GST and other taxes, they are the tax revenue, right? So we have the non-tax revenue and we have the tax revenue. In the tax revenue, it is the corporation tax which is occupying the maximum share. Which is occupying the maximum share. That means the corporates give the maximum amount of taxes as far as the overall tax is concerned, and the second highest is given by the income tax. Now coming to the expenditure, where does the rupee go? So where does the rupee go? So overall you see the maximum shares go to the states. So states share of the taxes and duties. So states have their share in the amount of taxes which are collected by the central government. So this is 20%, and this is very amazing. Interest payment forms 18%. That shows we have a huge baggage, right? And there are other items, specifically the defense expenditure and the subsidies. Subsidies are also very high. Trends in the tax receipts. This is very crucial. Already one question has appeared from this part of the survey in 2017, right? So there are total two taxes. One is the direct tax, another is the indirect tax. When we combine both direct tax and indirect tax, we get the gross tax, and this gross tax receipt as a percentage of GDP, that is called tax to GDP ratio. Right? So what is tax to GDP ratio? Tax to GDP ratio is basically the gross tax receipt as a percentage of GDP. So if we see, first of all, starting from 2011-12, almost 10 years ago, there was 10.2% tax to GDP ratio. Now there has been fluctuation. There was increase, decrease, then increase, then decrease, right? And finally it comes to 10.8 in 2021. So we are expecting that for the next year it will be 10.8%. So it's slightly less than the 11%. And can you see the pattern? There is a fluctuation. There is no steady increase or steady decline, right? This is one kind of question which can be asked in the examination. In 2017, this has already been asked. We will just see after this slide. Then the second observation is the comparison between direct tax and indirect tax. Why this comparison is important? Friends, direct tax represents the progressive system and indirect tax represents regressive taxation system. What is the meaning of progressive? Progressive means more the income, more the tax. Less the income, less the tax. Regressive means it remains same for everyone, right? So in practical life, how do we see direct tax? If there is some rickshaw puller and rickshaw puller is having the income of 2 lakh rupees in a year, rickshaw puller is not supposed to give any amount of tax. So this is possible because the direct tax is progressive. There is zero tax for certain level of income. However, the same rickshaw puller is supposed to pay the taxes on the item it buys for its consumption, clothes, transportation. So whether this is the rickshaw puller or son of the Ambanis, son of the Tatas, whosoever, whether the person is rich or poor, both the people have to give same amount of indirect tax. So indirect tax becomes the regressive because it does not differentiate between the rich and poor. Poor have to bear the disproportionate burden. Poor के ऊपर ज़्यादा burden आता है क्योंकि poor की income कम होती है और same income में से उसको tax देना होता है. Rich की income बहुत ज़्यादा होती है, उसमें से अगर tax दे भी देता है तो ज़्यादा फर्क नहीं पड़ता है. तो आप समझ सकते हो कि indirect tax is regressive and direct tax is progressive. So if we want to compare, direct tax should always be higher than the indirect tax in India, right? And this is exactly what is happening. Overall, you can see direct tax is consistently higher than the indirect tax. In 15-16 and 16-17, this was, merging. This was merging, but again after the 16-17, this has declined. You can see this indirect tax has been declining and direct tax has been higher than the indirect tax, right? So this is another kind of statement which can be asked in the examination. So the question of 2017 statement number 1. So this is the statement number 1. Tax revenue as a percentage of GDP of India has steadily increased in the last decade. We just discussed in the previous slide that there has been fluctuation, right? So this statement is wrong. Statement 2, fiscal deficit as a percentage of GDP of India has steadily increased in the last decade. Again, this statement is wrong because there has been complete fluctuation. So which of the following statement is or are correct? Answer is neither 1 nor 2. So this is the kind of question which can be asked in the examination. Here you can see the composition as a percentage of gross tax revenue, right? So this is as a percentage of gross tax revenue. Absolute amount remains same, but we are taking it as a percentage of gross tax revenue. Overall, direct tax is 54% of total tax revenue and indirect tax is 46%. We already discussed that direct tax is more than the indirect tax. Taxes as a percentage of GDP. This is very crucial. So, taxes as a percentage of GDP, we can see over here CIT, that is corporation income tax. Corporation income tax is 3.3% in 15-16 and in 19-20 we expect 3.6%. So there is increase or growth. TOI means taxes other than the corporation income tax. So this represents the personal income tax. So this was 2.1% in 15-16, now it comes to 2.7%. There is a huge jump. Then we have custom, we have union excise duty and we have GST. So GST, we can see there is a increase, right? Now coming to the expenditure part. So we just completed the discussion of the revenue part or receipt part. Now we are going to the expenditure part. On the expenditure part, just observe the different heads of expenditure. So these are the different expenditures done by the government. Out of this, just observe that defense is having, major debt subsidies are having this amount. Interest is the largest amount, right? So overall, you can see interest expenses is very, very huge. So interest is, eating the finances like a termite. So even if we do not borrow a single rupee in the current year, still we have to pay this interest amount. So this is a very alarming situation, right? Subsidies are very high. Defense expenditure is also very high. Overall, just see the relationship of the different subsidies. So food subsidy is the highest, fertilizer subsidy is the second highest, and petroleum subsidy is the third highest. In the examination, they can ask a question that which of the three subsidy is the highest, or they can ask the relationship that food is more than fertilizer is more than petroleum. Statement is right or wrong. So they can ask the question like this. Otherwise, you don't need to remember anything else. Transfer to the state, right? So as I told you, there are certain transfers. One transfer is in the form of devolution of taxes. Another is in the form of finance commission grants. And third one is in the form of central sector schemes, right? You do not need to remember these figures. However, you can observe just one thing, that the amount in 14-15 and the amount in 19-20, you can see there is a major jump, right? Every year in every component. Devolution, earlier it was 3.36 lakh crore, now this is 8.09 lakh crore, and similarly other item. This sudden jump is because of the 14th Finance Commission recommendations. So 14th Finance Commission recommended sudden jump of 10% to the state government transfers, right? So from 32% earlier, now 42% is the amount which is to be transferred by the central government to the state government. Central government transfers to the state, you can see these figures. Again, these are not important. That's why you don't need to apply your mind. Trend in the center's debt to GDP ratio. This is very crucial. So, just to recall, NK Singh committee recommended how much? Less than 40% of the GDP, right? So, here in 2004-5, if we see, the trend was more than 55% of GDP, right? Now, in 18-19, we are expecting it to be approximately 45%. So, there is a huge control. There is a huge control, right? So, this can be asked in the examination as a statement. They can ask a question that there is a steady decline. There is a steady decline in the center's debt to GDP ratio in the last 10 years. So, starting from here, we can see there is a decline, then there is an increase. So, there is a fluctuation. If the question comes, there is a steady increase or a steady decline, both the statements are wrong. Major deficit and debt indicators of state. So, states' deficits are also important. We should also see the performance of the state, because states are part of the general government, and NK Singh committee has recommended that combined debt of state and center should be 60%. So, if we talk about the states, gross fiscal deficit, earlier in 2012-13 it was 2%, now this is 2.6%. So, there is an increment. Revenue deficit, earlier it was very less, now it is little bit higher. Debt to GDP, it is also increasing, right? So, comparatively it is increasing. Trends in government, general government debt and deficits. General government again indicates both the center and the state combinedly. Now, coming to general government fiscal deficit. In 12-13, general government fiscal deficit was approximately 7%. Now, in 19-20, this is approximately 5.9%. So, this is a very good indication. That is why the survey has said that both government are moving towards the fiscal consolidation. This is a very good indicator. General government revenue deficit. So, earlier it was little higher than the 3%. Now, this is just 2.3%. Again, this is a very good indication. Outstanding liabilities of the general government. So, that is basically the combined debt. So, earlier it was around 66%, and now this has increased to around 70%. This is a very dangerous situation. This should be approximately 60% only. As per the NK Singh committee, this should not exceed 60%. Talking about the tax proposals. So, tax proposals are part of the public finance only, because they impact the tax revenue. Concessional corporate tax rate of 15% to new domestic companies in the manufacturing and power sector. So, earlier our corporate income tax rate should used to be 30%. Now, they have decreased it to just half for manufacturing and the domestic companies in the manufacturing and the power sector. So, this also indicates that they want to promote the Make in India and they want to promote the domestic manufacturing, right? Tax concession for sovereign wealth fund of foreign government and other foreign investment. This will attract the foreign direct investment from the sovereign wealth fund. Tax benefit to startups. Again, you do not need to get into the detail of each one of them. Just need to see that which all sectors have been incentivized by the government. Concessional tax rate for the cooperative turnover threshold for audit of MSME. So, there is some benefit to the MSME, there is some benefit to the cooperative, to the startup, affordable housing, charity institutions, medical equipment. So, this point is important. Health cess to be imposed on imports. Health cess to be imposed on imports of medical equipment, given these are made significantly in India, right? So, the government want to promote the manufacturing of the medical equipment inside India, right? So, this is also indicating the kind of protectionism policy of India. right? So world over, we are in the era of protectionism. So why should India be left behind? This is very major reform, although this is an old wine in the new bottle only, nothing special, but still existing tax rate and the new tax rate regime. So there is a new proposed slab system, right? As of now, between 0 to 25 lakh rupees income, there is 0% tax. In the future also there will be 0% tax. Between 2.5 to 5, there is 5%, and 5% is also proposed. Between 5 to 7.5 lakh, existing there is 20%, 10% is proposed. Between 7.5 lakh to 10 lakh, existing 20%, 15% is proposed. And so on. Above 15 lakh, there is 30%, and now 30% is proposed. So you do not need to remember each one of these figures. You just need to know that now the government has given the option, either the taxpayer can continue with the existing tax rate, and in the existing tax rate they can claim exemption and deduction. They can claim the exemption and deduction. For example, when they invest into the savings, they can claim that amount as the deduction from the income tax. But in the new tax rate, the income tax rate have been reduced, but they cannot claim the exemption and deduction, right? So taxpayer have the option to choose either existing system or new system. Both the options are available. Then there is a tax called dividend distribution tax. So this tax is levied when any company distributes the dividend. Dividend, what is the meaning of dividend? Dividend basically means the share of profit, right? So when company distributes the dividend to the shareholder, at that time the company was supposed to pay dividend distribution tax. Now this dividend distribution tax has been eliminated from the company. It is the obligation of the shareholder. So shareholder will be giving the taxes. What is the impact of this? The impact is that when it was DDT, then company was mandatorily required to pay the tax. And when this is part of the income of shareholder will be paying the tax only when the income of the shareholder is more than 2.5 lakh. If the income is less than 2 lakh, then shareholder do not need to pay the dividend tax. So this DDT in a way will promote the capital market investment. It will promote the investment into the companies. Simplified and new tax regime as an option to the old regime. I already told you that this new tax regime is the optional. This is the optional. This is not the mandatory. Simplified GST return shall be implemented from 1st of April. We already saw that. These are the budget allocation to major schemes. You do not need to remember the figures. Just see which all schemes have been given and go to your study material, cover these schemes, the basic features, because there are chances that in the examination they can ask the basic features of these schemes. Chapter at a glance. Out of these structural reforms we have seen, states have continued to be on path of the fiscal consolidation. General government is on the path of fiscal consolidation. Going forward, considering the urgent priority of the government to revive the growth. So we are in the middle of the cyclical slowdown. So our priority is to revive the growth, not to control the fiscal deficit. In the economy, the fiscal deficit target have to be relaxed. So here you can see escape clause coming into picture. Escape clause proposed by the NKC committee, that is coming into picture, right? With this I complete the session, and I hope you enjoyed. Friends, I request you to share, like my lectures, and give your comments. What did you like, what did you not like? Whatever you expect from my lectures, please give in the comment so that I can improve and I can give my best to you. With this, I conclude the lectures, and I really want to thank you for listening. God bless you. Thank you very much.